Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 4th, 2025, recording this about 7 o'clock in the morning. All right, so let's have a look at some charts. There's been some quite interesting developments. What I want to do, guys, is just to start off the day, just doing a quick overview of two or three markets and looking at a few things here. Yesterday, we did get the announcement from Trump that there would be more tariffs going on China, so an extra 10%. So it looks as though we're getting 20%. He seemed to confirm that at midnight last night, so about 7 hours ago, we would have the 25% tariffs on both Mexico and Canada. There is a little bit of confusion. So I've been reading some stuff earlier this morning, saying, did he actually sign the executive order? Has this actually happened? But certainly verbally, he said as much. But there's been a relatively muted reaction in both the Chinese peso, the Chinese renminbi, the Mexican peso, and the Canadian dollar. And one issue is to say, well, it was already priced in. Secondly, it's about the US dollar and sort of a bit of a concern about US and global slowdown. Or maybe just the market is saying, hold on, technically these tariffs actually haven't worked yet. But we'll get through that during the day. But what does seem to be getting the market's attention overall? The market now really seems to be looking, I'd say, at two or three things, but specifically the more that Scott Bessent from the US Treasury keeps on talking, and he's talking with journalists every 2 or 3 days, doing interviews. He seems very focused by saying that he and Trump do definitely want to focus on the 10-year yield. They want the 10-year yield to come down. They want gas prices or petrol, oil, gasoline prices to come down, and they want inflation to come down. And it seems to me that they have a pretty clear plan that the way they're hoping to do that is to cut jobs in the public sector, in government jobs, is to reduce the deficit by reducing government spending. But if you actually step back and look at all of this stuff, yes, this could be sort of deflationary, which would get the 10-year yield coming down. But also what it's going to do is to increase the unemployment rate at some point, in some magnitude. And this is going to cause a slowdown. Allied to that is this whole issue of sort of tariffs, reciprocal tariffs going potentially on Europe. Obviously, we've already seen on China and sort of Mexico and Canada, and potentially also now on other countries like Japan and whatnot, and a weaker dollar. So you put it all together, and the market is really thinking, there's a lot of uncertainty. Let's just put it that way. I'm not going to use the word chaos, but let's just say there's a lot of policy uncertainty. There's definitely going to be sort of less efficient supply chains, and global trade probably will suffer. And potentially in the US, could you have deflationary sort of impulses because of a slowdown there, or could at specific products it could be inflationary. We also have, of course, the geopolitical overlay. So you put all of this stuff together. There's a lot of uncertainty. There's the belief that tariffs in some shape or form have arrived and will continue to keep on happening. Geopolitical uncertainty and potentially sort of some kind of stagflationary mix where the global economy slows down. But because of tariffs, there are still pockets of sticky inflation. So putting this all together, this is not a positive kind of sentiment, especially for stocks. So now let's just look at a few different markets. And what we can see, which is pretty interesting here, you can see if we look at what I'm going to look at here is just for the Federal Reserve, because as we know, just going back to, let's say, the 18th or 19th of February, which is essentially, I don't know, a couple of weeks ago, we can see that by the end of this year, so the end of 2025, specifically what we're looking at here is for the December 2025 SOFR contract. The implied yield, it was at about 35 basis points. So something like about, 1.5 cuts, 1 to 1.5 cuts were priced in. But as you can see, this is a 15-minute chart. This has steadily gone downwards until we reached, as we speak, it went down to 80 basis points, but in basically negative 75. So we're now at 3 cuts for the year. 3 cuts for the year. So essentially, and you can see that here, this is the number of cuts, and this is just the tabular form of what we just saw on the graphic there. So now 3 cuts, and if you go all the way out to the end of 2026, you've got 4 cuts. So basically, at least in the US space here, the market has said, things could slow down. There could be a rise in unemployment. And the idea about the inflation is perhaps less of a worry because there's really been in the last week or so a bit of a narrative developing that inflation might come down, not because of sort of healthy factors, but maybe, some kind of mini recession, more unemployment in the US, as I said, in the public sector, especially, and a general slowdown. So that's where the market is at the moment. A relatively dovish repricing, over the last couple of weeks of the Fed. And we can see that in something like the SOFR curve here. So let's say, for example, we look at the curve, and this is the live curve now, and you see the terminal rate here. The terminal rate looks like it's about 3.5% or so. But if we go back, let's say something like a week, you can see it was much higher. If we go back a month, you could see even higher. So let's just zoom in there a little bit. And what we're seeing here is, again, just to make this clear, this is just from a month ago. And you see a month ago, the terminal rate was about 3.88. So that's come down significantly. And then a week ago, so you see that all across the curve, the pricing for the number of cuts has gone up. And so the implied yield has gone down. And also what we can see here, you see, let's say a month ago, a much shallower sort of a cutting cycle. So just cutting down a little bit here and, pretty much basing out. Then a week ago, a bit deeper. Now, quite deep, going down to, as we say, with the Fed funds down to about 3.48. And keep in mind that it's about 4.33 at the moment. So almost to 4 cuts for the whole kind of cycle, which is a lot more than even just a month ago, where we were at something like about, a couple of cuts or so. So a much deeper cutting cycle and with a lower sort of terminal rate. And you see that here, the big changes have been towards the end of the year. So you hear December 25, March, June, September 26. So you see here the really big changes haven't been for the next 2, 3, 4 months, but really towards the end of this year. So what that's telling us, and we're also seeing that with the flattening of the curve, is that the market is saying that, the economy is not going to slow down tomorrow or next week, but it could be a story starting maybe in the second quarter of this year or even the third quarter of this year, and that's been reflected in the pricing here. Also interesting is just to look at the VIX curve just for volatility. The market is still nervous. You see. As we speak now, this is the spot price. So this is a live price. You see here, 22.9. Let's call it 23. So the VIX are pretty high here and much higher than the front futures contract and the second futures contract. So in a fairly significant backwardated state here, which does indicate risk. And again, if we just go back and look at this and look at, let's say a week ago and let's say a month ago, and we actually don't really need to zoom in here particularly, but if we just look at that, we can see that a month ago that the front the VIX spot was trading around about 17. So not only has the front price gone up for the VIX spot, but we actually look at the shape of the curve here. That was a flat curve, and before then was even a little bit in contango. But as we can see, the front end of the curve on the volatility curve, on the VIX curve, is actually going into a backwardation, which indicates a lot more stress and nervousness and desire for protection and potential for volatility, right now and immediately. And if we consider, as is like to saying, just what this number means, if you divide this number by 16, what was the number here? We've got 23. So that's 23 divided by 16. That'll give us 1.43. So about 1.43%. That is what the market is kind of pricing in mathematically for a typical volatility move today. So that's why we're getting in something like the excuse me, the ES futures or the SPX. We're getting moves of over 1% or 2. So just mathematically pricing in about 1.45% of moves today. Other interesting thing, just so I've got the Bloomberg terminal up here, is the price of crude oil. Crude oil. I mean, a couple of interesting things yesterday. I'm just looking at the curve here. Basically, we had an interesting announcement from OPEC Plus. I don't want to say a complete surprise, but essentially they had been postponing for months and months and months and months and months any increase to the production. You remember that they cut their production, so they're producing below their total maximum capacity by about 3 million barrels. They cut that like 18 months ago or so, maybe 2 years ago, and they'd been putting it off. But essentially, and who knows, maybe this is a phone call from Donald Trump, who's very, very keen to have global energy prices down, specifically gas and petroleum. But basically, they decided yesterday that starting from April, the OPEC Plus confirmed that they would slowly start to increase their production. Now, at this point, it's not a huge number. We've only got 138,000 barrels a day. And to put that into context, global oil consumption is about 100 million barrels per day. So 138,000 barrels, 100 million. It seems like nothing. But the point is they're going to start ramping it up. And the idea is that over the next year, they will increase that by about 2.2 million barrels. So that is significant, but also I think really the question is really kind of symbolic here, is that just as we're starting to get this sort of nervousness around tariffs, global trade, potentially a slowdown in the U.S. economy, a geopolitical risk, suddenly OPEC Plus is actually increasing their output. So if nothing else, it's symbolically pushing more barrels of oil onto the market. Having said that, though, there has been some discussions about the US putting further sanctions on Iran. We know that Iran, over the last year, they've increased their production by about 1.3 million barrels. So who knows, potentially if the Americans decide to sanction Iran a little bit, maybe there's some kind of deal with the Saudis and the Russians saying, hey guys, you produce more, that'll push down the price, but don't worry, it won't go down too much because we, the Americans, we, the Trump administration, we will put sanctions on Iran. So it could be a quid pro quo, and maybe the 1.3 million barrels, extra barrels of Iranian oil might actually be, somehow taken off the market and counterbalanced by the extra OPEC Plus supply. It's a bit murky, but the point is that oil this morning is down and has been going down since that announcement. I'll look at the chart in a second. But again, kind of interesting just to see where we're at. This is the live price here, trading about 67 bucks and a half for the WTI. Brent's up at about 70 or so. And if Brent goes below the $70 barrel, it could go a lot harder. But let's have a look here. Let's say a week ago, and let's say a month ago, and you just see not only the outright price. So you see the outright price a month ago, we were looking at about $72. So it's come down about $7 or so, but also the shape of the curve, which had been flattening. And you can see now, the shape of the curve, which earlier in the year, at the end of last year, was in quite a steep backwardation. It's it's a little bit, getting sort of flat. It's still technically in backwardation, but definitely not a powerful backwardation here. So oil sort of under pressure. Again, while we've got this up here, just want to have a look and look at the data. Yesterday, we had a little bit of data. We had the ISM manufacturing. That was a little bit weaker than expected, but with strong prices paid. So if we actually go back and have a look at that, which we can do here if I put that on the 3rd of March. So if you just go back and look at that, look at these prices paid here, up to 62. So that's a very, very elevated level, way above the expectations of 56 and higher than last month, which was 55 essentially. But allied to that, you have the new orders, which was down in contractionary territory. So remember, anything less than 50 indicates sort of a tailing off of the numbers. So here, contractionary for new orders, and also employment also below 50 at 47, much below. So we have a pretty unattractive situation there, whereby the ISM manufacturing was saying, hey, producer input prices are higher, sort of inflationary, whereas new orders, so future orders and also intentions to employ people, is going down. So that's like a stagflationary mix, where inflation, but with a mix with a stagnating economy, which is not a good combination for stocks. At all. Okay, today, what do we have? We don't have particularly a lot today. Where are we? The 4th here. So today we don't have much at all. Tomorrow things start to ramp up a little bit in the sense that we get we get ISM services. We also get some durable goods, but that's a final order. And we also get the ADP number for the private payroll. So today, the focus is most probably going to be on just to see what's happening with oil, what's happening with stocks, and also European stocks. And of course, very, very important, guys, Trump tonight is talking to the joint houses of Congress, so the House of Representatives and the Senate. So this is a big showcase kind of speech. There's been some kind of talk, some kind of rumors that possibly Trump will announce American intentions to withdraw from the NATO alliance, which has been the cornerstone of kind of the North Atlantic, US, Canadian, European military alliance since basically the end of the Second World War, so we're talking about 70, 75 years of NATO. So if Trump were to withdraw or announce the intention of the US to withdraw from NATO, that would be a very, very, very big deal geopolitically. And at that point, you really have to start saying that we are in a complete realignment of global alliances and geopolitics. Today, here in this video, is not the right moment to talk about that, but that is creating, quite a lot of nerves. So let's actually just look now at a couple of the charts, just see where we're at. Let's see what we've got here. I'm not going to look at absolutely everything, but I'll just, for example, let's have a quick look at oil, because oil is going down. And it is interesting because when Trump came in, he said, and Besant, they said that they wanted, lower oil prices. Well, they're getting the lower oil prices. They wanted a lower yield and they're getting that, but they do want the 3% real growth. I'm not sure they're going to get the real growth. But their theory seems to be that we'll put everything in place to have deflation and realign the global trade systems. And then, maybe in 6, 12, 18-month time frame, the onshoring of sort of more manufacturing and business into the US will start the economy to reaccelerate. And who knows, maybe that's going to happen. We had a talk yesterday about, chip factories being opening in the States rather than Mexico. We had talk last week, Tim Cook of Apple saying that they're going to start building a factory or two in Texas rather than Mexico. So maybe that's going to happen. But just looking at the charts here, we see here that on the CL1 sort of a futures contract broke above this sort of little trend line here. I think this could be going a little bit lower. We're probably getting towards the lower bounds here. If you look at the front contract April, it looks there's like a pretty strong support down around about $66. It could be that, as I say, on this potential extra supply from OPEC Plus, allied with a scare about growth, global growth, oil could just bleed down a couple of dollars here, and then probably would find a base. I mean, I can't really imagine it collapsing at this point because oil demand is still relatively robust. And the same thing here if we look at Brent. Getting to very key levels here around about the $70 mark, you can see that this is a pretty strong support level here. So we're getting to levels here where we could find some support. So maybe today it could bleed down a little bit. We see also the time spreads. If we look at December 25, December 26, pretty negative here. So as we saw with the curve, this December 25, December 26 spread is negative. So oil going down again. That potentially is deflationary, which should be helping the bonds. What is actually very, very interesting is the dollar. Now, this is the dollar index, which we know is about 57, 58% euro. But also, I think a 10, 12% the Japanese yen. The dollar here failed to break out of this sort of bull wedge kind of thing here, coming back down now. And at this point, you've got to say, starting to break below the 38% on the big fib retracement here, going all the way back to this impulse of the 1st of October. So breaking down below there, potentially breaking down below the as I say, this sort of fib level here. And what I might put on, if I can find it, is let's just put on some moving averages here, just to give us a little bit of context here. So yeah, I've got the EMA. So it's broken down below the 100-day moving average, going down towards the 200. And it looks as though that could be the next stop, down to about 105.5. That looks like a good technical level there on the dollar index. But also let's look at some of the other ones. If you look at the euro here, very, very interesting. I've been signaling this level for a long time and been looking at the 105.30, 105.50 level. And here we are at 105, essentially 50. Two very big green candles. I've got to say this looks bullish. We're above the 100-day exponential moving average. The shorter day EMAs here, you see the 20 and the 50 are kind of rolling upwards. This looks as though it wants to break out. I still believe, I don't think this could go a massive amount, but it does look as though maybe to test this recent high at about 106.30, which would also coincide with this downtrending 200-day exponential moving average. So that could be the next target. At the end of the day, the US, again, what I want to say, and it's very important, is there's a growth scare. But do we actually have real evidence that the US economy is slowing down? We're going to get some information with the non-farm payrolls, which is a lagging indicator this Friday. But I think it's going to be quite interesting to me just to sort of see what's going on because yesterday with the tariff news, the US dollar actually went down. And you see that very clearly with something like USD CAD. We initially had a pop for a couple of hours, but now you see that US dollar CAD actually has come off. And you see since the session opened down almost like 50 basis points here. And you've got to say, what the hell's going on here? That, 25% tariffs on Canada, and yet the Canadian dollar rallies on that. Now, for sure, you could argue that potentially a lot of this was priced in. But I would say overall, if you have a trade war between Canada and the US, this is not good in the medium term and even in the short term for neither Canada, less so for the US, but for Canada. So this is very curious to me. And I just wonder if you put that with the euro, what's going on, a lot of strength, and also the Japanese yen being very, very strong. And this is actually interesting because it's broken down significantly below this pretty important 50% retracement level, well below all the moving averages. You can see here are rolling downwards. And you've got to say that this looks as though the next stop at a minimum is down maybe 147. Let's call it about 147-ish, which would be the 61-day, 61% fib retracement. But what we're seeing here is that the US dollar and against the Swiss franc as well, it's down today at the 200-day moving average. EMA, the US dollar is being pounded over the last 20, has been pounded over the last 24 hours. And I think what's going on here is that, as I say, it's this narrative of a recession, lower yields, sort of chaos. And normally the US dollar would be a beneficiary of sort of safe haven flows. But what we're seeing here is that the safe haven flows, if indeed that's what they are, is going to the Swiss franc and the Japanese yen, less so to the US dollar. So a lot of outperformance here of the yen and the franc also on the cross pairs compared to the US dollar. And I think the idea here is that the market is really saying that, Trump's policies causing uncertainty, chaos, and the imposition of tariffs ultimately will lead to a situation, of higher unemployment, maybe less deficits, but a weakening in the U.S. economy in the short term, which is a negative for the U.S. dollar. I'm not completely convinced that the U.S. dollar is going to collapse, so I'll be looking for sort of levels, but. Definitely kind of interesting price action, especially with the CAD. And we also see that in China, if you look at the offshore renminbi here, I mean, look at this. This is USD China. You go, oh my God, the US just imposed 20% tariffs on China, and look what happens. The US dollar sells off very, very hard. So interesting days here. And this kind of nervousness is being reflected in the stock market. We looked at the VIX. You see the VIX here, as I say, pretty elevated. It's above the 20.5 level, which for me is quite key. So this is going up. This is not good for the stocks. If you look at the SPX, you can see that you were talking about this election gap. We actually now closed in that yesterday afternoon. So this green candle, which we had on Friday, sorry, I beg your pardon, and we now have an engulfing red candle. So this is pretty negative from a technical perspective here. And you've got to say that, first stop on the SPX could be just to retest this election gap around about 57.81. And if it wants to break, then, maybe all the way down here, which is, there's a lot of levels around about the 56.70, which is like the 200 EMA. There's also horizontal support there. And if you look at the front contract in the futures, you can see even in the session since 6 p.m. last night, just breaking down. And, we're now down sort of into that election gap, as I say, and going down to test. Probably this looks like a pretty decent sort of target down here, 57.20-ish, which is the 200 EMA, which, as you can see here, coincides with a bunch of sort of horizontal support as well. So stocks under a lot of pressure. Similar situation with the NDX, the NASDAQ. We also had some chatter overnight that Singapore, maybe some NVIDIA chips are somehow being shipped to China. Some of the more sophisticated chips via Singapore. There seems to be some sketchy things happening with the accounting of Singapore. So maybe it's a backdoor entrance of NVIDIA chips into China. That's not good for the semiconductor index. It's not good for NVIDIA. And if we actually look at the NVIDIA chart, which we shall do, NVIDIA, stocks. You can see that that's very, very ugly. And after those earnings, you see here, it's interesting in the price action. You see here the DeepSeek It gapped down, and then it was like, oh, actually, Capex is still happening. The earnings was good for a few hours, and then since then it's been absolutely hammered. Now trading down below the 200 EMA here, so pretty negative price action there, and that's dragging down obviously the tech sector. We can see Mag sevens in general just really falling pretty hard, about coming up to the 200 day. We also see the equal weight, not doing well at all. So stocks under a lot of pressure. Also, we can look over in Europe, and finally, pretty big breakdown. There's been a lot of happy talk about, European defense stocks, et cetera, et cetera. But if you start talking about the US pulling potentially out of NATO, and you start talking about tariffs being imposed almost universally on all of the US's trading partners, and you start talking about the car exports being tariffed, you're talking about agricultural exports being tariffed, and retaliatory tariffs, not to mention all the geopolitical shenanigans going on. It doesn't make sense to me. It does make sense to me that the Euro stocks finally just feeling a little bit of pressure, also in sympathy, of course, with the American stock market. So kind of again, interesting action here on the Euro Stocks 50. Sort of, it failed to make the double top, and it's like, oh, that's a double top retest, and then people saying it's a bull flag. It poked its head above for a new high, and then it has been slammed today. So let's see where that ends up. But still outperforming in the sense the US. So there definitely has been money flow. We also look over in Germany. A bit of red today. And some of that's possibly on this idea also of issuance. There's been a lot of talk. We hear it every half hour on the wires of infrastructure spending, massive infrastructure spending in Germany and in Europe, also on defense. So the thing is, there's going to be a lot of bonds issued, which is going to push up the yields. So that's definitely going to be steepening the curve. If we look over, let's just have a look, see what's been going on. So if we look at the US, hold on, let me find there's the, yeah, so here's the German 230s, more steepening overnight of the German curve. You also see, let's say, the twos tens in Germany steepening. And if we just look at something like the German 10-year yield, you can see that that's been going up, and the German 30-year yield has been going up as well. So the point is here that there's got to be more issuance. And at the end of the day, the stock market is not going to love in Europe either the higher yields. So that's sort of interesting. The other thing as well is just at a certain point, if there's going to be more issuance and a lot more spending, at what point, and this is something I'm looking at what point will some of the more fragile economies, maybe sort of like Italy or Spain, at what point will they start to show a bit of pressure on the spread? At this point, zero pressure here on the Italian-German spread, still very comfortable at lows at 106, 1.06. If we look at France, that's starting to go up a little bit more. But I'm just really interested to see at what point countries like Italy, Spain, Portugal, they'll be under a little bit of pressure with all of this extra bond issuance all across Europe. What is interesting, just to finish off here, is just in the US space in terms of the bonds. And we saw that look at this. This is the yields in the US absolutely going downwards. We saw that with the repricing of the Fed. But the 2-year yield, I'm going to be honest and surprised just how far the 2 years been pushing downwards. We also see on the 5 pushing down, the 10 less so, and the 30 less so. But the US yields in general have really been pushing down again, just on this idea of a growth slowdown. Okay, guys, so I'm going to leave it there. I've probably spoken too much. Let's keep our eyes on everything today. Personally, I'll be looking at oil, European stocks, and the Canadian dollar. Kind of curious to see what happens there. Also, I think it's absolutely essential to be tuning into the Trump speech, even despite the politics, whatever your politics may or may not be. A lot of people are anticipating that he could, indicate some more pretty important things in terms of geopolitics, but also economic news. In terms of the plans and tariffs, we shall see. I think that's normally those speeches are about 9 p.m. Eastern. Okay, I'll leave it there. Have a great day, and we shall be talking soon. Thank you.